Hello, everyone. Welcome to today's session, 3 smart strategies to protect your savings from inflation. Very quick declaration. The information provided is for general guidance only. We recommend consulting a qualified tax advisor or tax planner before implementing any tax planning strategies. Also, we're not licensed financial planners and do not provide financial product advice. For personalized investment guidance, please consult a licensed financial planner. Right. Okay. So first, let's have a look of a case study. So why is your saving account shrinking in value? Okay. Once we have a look at the case study, you'll understand why. Okay. So Sharon has a bank saving account with a balance of 100K. The earnings will be 5% interest per year. And this account will generate $5,000 in interest income every year. And let's assume that Sharon's marginal tax rate is 47%, and she'll need to pay $2,350 in tax on her interest income, leaving her with an after-tax return of $2,650. So basically, the effective interest rate here is 2.65%. Okay, then let's assume that the inflation rate is 3.5% when Sharon is having this bank saving account. Then the purchasing power of her savings is actually decreasing or eroding. Okay, despite earning interest, the real value of her savings is declining over time. All right. So when the investment return is not beating inflation, of course, the value of the saving account will be eroding. All right. Then, so how do we tackle that? So first, we need to have a look at the key factors we need to consider. So there are factors that's actually beyond our control. Okay, inflation rate and bank interest rate. So we can't really control those factors, but there are factors that we can control. Okay, yield on alternative investment choices or our own income tax rate. So let's have a look at different strategies on the two factors that we can control ourselves. Okay, strategy number one, consider other investment choices. So for example, moving in saving account, okay, saving amount to high yield accounts such as term deposits or bonds, and also consider diversifying your financial portfolio. Consider real estate investments or precious metals, gold or silver, index funds or ETFs. Okay, so of course, before you make any investment, you have to consider your short-term and long-term financial goals before making investment decisions. All right, so because we're not licensed financial planner, but I do have a Master of Financial Planning degree. If you need any general advice on this, please let us know. All right, your financial goals and the time frame of your investment. Okay, strategy number two, use different investment entity. Okay, this is mainly focused on possible tax savings. Okay, so investments through a family member potentially. So allocate interest earning investments to a trusted family member with a lower income to reduce overall tax burden. So say for an example, sometimes the daughter might be paying 47% on the marginal tax rate on herself. Okay, so when she got a 200K saving account, she trusts the parents, trusts the mom. Okay, the mom is retired and doesn't have any income. Potentially, the mom can help the daughter, okay, to have this term deposit or saving account, okay, and earning interest income. So that's actually family members helping each other. And then investment through a family trust. So a discretionary family trust can distribute investment income to beneficiaries in lower tax brackets, optimizing tax efficiency. Of course, family trust is a very complicated structure, so you do need to consult with a qualified tax planner to understand how to do it. But generally speaking, when you have a family trust, so let's assume, okay, if the family trust has a 200K term deposit or saving account, the interest earned will be treated as the income of the family trust. Then you can actually pick and choose a family member to receive this income, okay, and then basically a beneficiary distribution, and that beneficiary will be paying tax on his or her own marginal tax rate. So choose a low income earner beneficiary, okay, you can actually reduce the tax. All right, the next one, investment through a company. So a company structure is actually paying flat rate of 30%. Okay, so when it's related to income or basically passive income related to interest, okay, that the tax rate is actually 30%. And then tax paid can be utilized as a franking credit in future years when dividends are distributed to the shareholders. So that's actually going to reduce the shareholders' tax liabilities in that year when she or basically when the shareholder is receiving the dividend payout. All right. So that's using a different investment entity. Okay, strategy number 3, also focus on tax savings. Okay, utilize other tax planning strategies. So first, one we are considering is superannuation contributions. So when someone is making concessional super contribution, so that's going to help you to reduce the tax, of course. And then, of course, if you're aged above 60, withdrawals from a tax-free super pension account are completely tax-free. So you can actually set up transition to retirement strategies. Okay, potentially utilize super to help you to reduce your tax on potential investment income as well. Okay, and then investing in tax-effective assets instead of saving accounts. Okay, so frank dividend stocks, Australian shares with franking credit will reduce tax payable because the franking credit will come in as a tax offset. All right, rental property investments, interest on investment loans is actually tax deductible. So at negatively geared property can help offset taxable income and then reduce overall tax as well. All right, then of course, if you can leverage deductions and deferrals as well. Okay, so this one is more on the timing of your deduction. So when you prepay expenses before the financial year end, and then you can actually claim the deduction earlier. Okay, then maximize deduction for your current year, and then reducing your tax as well, and defer income to the next financial year to manage tax liability. Okay, so you can, that's actually similar, just on the other side of prepaid expenses. Yeah, you're basically moving your tax liabilities to future years instead of you have to pay in the current year. So wherever possible, you can do that. And then, of course, utilize FBT exempt benefits to cover living costs, such as what we have mentioned in some of our other FBT related sessions, okay, for office meals and refreshments. So that's mainly utilized by business owners, and it can potentially be seller packaged with salary as well for any FBT exempt items such as electric car purchase, minor benefit. Okay, so they can all potentially come in to help out all those strategies. All right, so that's basically the main 3 strategies, and we've added our contact details here and also a brief introduction about myself. If you have any questions about tax planning strategies, give us a call, write us an email, then we'll try our best to help you out. All right, that's everything. Thank you so much for joining us in today's session.